So anyway, it was the recap. We haven't started yet. So that was the last lecture of market expectation. And what we're going to do today is on the risk management and rebalancing. While it is not required in the GBA, I'm not sure whether some of your can read the advanced because some of the tools that we're going to cover today are actually quite useful, right? But nevertheless, if you did not, it's fine as well because it's not part of the GBA requirement. Thanks for the reminder for the recording. Okay, so Leo, um, any questions regarding what we've covered in the past, 3 lectures, 4 lectures? Right? Yes, we are good. Okay, so today what we are focusing on is risk management. We are going to look into some derivative products to manage risk. In particular, we'll cover things like forwards, options. Then we go into things like rebalancing. When do we need to rebalance our portfolio? What type of rebalancing are there? Right. So that's our main topic for today. So before we really dive deep into risk management using various derivative products, um, let's try to understand what kind of risks are there, right, in the market. So let me just pull up my pen. Okay, so type of risk. The key risk that we like to focus on as a portfolio manager is, first of all, market risk. So market risk is anything relating to changes in price, volume changes, maybe even sudden change in stock prices, and bond prices, interest rate environment. So everything relating to things that kind of dictates the market, dictates the stock movement, bond movement, that's your market risk, right? It's closely linked to demand and supply. So if you have been following the market, we know that in recent months, there's quite a bit of exuberance in tech stocks, and there's a lot of momentum in that aspect. So really a lot of demand from this perspective, right? Some demand push in the market. So of course, there's risk associated with that. If there is a exuberance in tech stocks, there are other sectors that are lagging behind, right? So if you look at things like manufacturing or even machinery, so like companies building machinery, you look at the market, they're actually not doing too well this quarter. Credit risk. So credit risk is a risk that is really hard to mitigate in the sense that all counterparties, regardless of the type of counterparties, all have credit risk, right? So in a sense, let's say we have a treasury bond. Our treasury bond is issued by the government, and the government has credit risk as well. The government can default, right? So that is credit risk. Of course, in the more conventional aspect, so this is the government. In the more conventional aspect, it's more corporate issuance. So like it's a stock, the company is issuing the stock to the market, and the company might go bankrupt. And if they do, then that is a credit risk situation, and there can be loss associated with it. We'll understand this thing called settlement risk. So when we look into derivative products, there's an element of settlement risk, whether the counterparty can actually return you the underlying, right? And if some of y'all might have some experience in derivative products already, you know that all derivative products, as the name suggests, the value is derived from the underlying, and therefore, if the counterparty cannot settle the risk, or cannot settle the underlying, then we have a settlement risk. Yeah, we'll go into details in just a bit. Liquidity risk, basically, things, certain kind of stocks, maybe a small cap stocks, but less liquid compared to stocks that are traded actively in the market, like large cap stocks. So when there's a possibility of certain kind of losses based on this, based on the illiquidity of stocks. Yeah. The most common measure of risk is the VAR, right? So this is going to tap on the bit on your statistics module in the past. So what's VAR, right? So VAR is basically what's the value at risk here. And the VAR uses a kind of probability measure, and it uses the idea of a normal distribution here, as you can see here, right? So we want to estimate what is the maximum loss, right? Based on certain parameters that we put. So it could be a 5% here, or it could be a 1% type of situation. And if you recall in your statistics course, when we do probability testing, hypothesis testing, we do things like, oh, what is the 5% confidence interval? What is a 1% confidence interval or something, right? So the VAR measure basically relies on this idea of statistics as well. So this idea, what is okay, so there's an example here. So a 1 million daily VAR at 5%. So it means a 5% chance loss of at least. So this is important. A star here is at least 1 million, right? So in a normal distribution, what we're looking at is here, right? At least. So is at this point, you can make a loss of more than 1 million in this case, and in one day. And the VAR measures the minimum. So this is important, right? So it's not the maximum loss, it's the minimum loss. And because we are using normal distribution, something highlight it's using probability. And an important thing is that only VAR with the same period can be compared, which makes sense, right? In the sense that you can't compare a monthly VAR with a daily VAR because monthly VAR might have more fluctuation, meaning you could have higher loss amount compared to a daily VAR, depending on the stocks, right? Or depending on what instruments you are assessing. Of course, the potential of loss increase over time if your period is longer. So like I mentioned, a daily VAR is less, like the likelihood is a less fluctuation compared to a monthly VAR. Right? Okay, so that's kind of like the rough understanding of VAR. Let's go into the calculation of actually how do we determine the VAR, this thing called VAR or value at risk. And so we fall back on the idea of a normal distribution again. Let me just draw the normal distribution graph. And recall in your normal distribution back in your statistics course is that whenever we say, we want a 5% confidence interval, right? Basically, what we are saying is that we usually need to determine the z-score. And when we determine the z-score, we use in Excel, the inverse standard, because it's a standard normal distribution. We use the inverse standard norm to find what's the z-score here, right? So taking a step back, the VAR basically measures, okay, what's your expected return? Okay, let's look at this first, expected return, minus the z-score, which is what we calculated here, times the standard deviation, right? So we are saying, okay, what's the expected return? So expected return, in other words, your mean returns, let me use the different color, it's here, right? Your expected return. So what is the 5%, let's say we are doing a 5%, what is the amount that is here? The amount of losses, okay, this is not losses. Let me do it quickly. Here, losses, right? Losses is on the left. So what is the amount of losses that we expect at a 5% confidence interval or 5% level? And to determine this, we use the z-score multiplied by the standard deviation to get this portion of the graph. So this is more of the pictorial version of how we understand this. And this is the portion where we're calculating the VAR here. All right. Why is it a negative? Because we are interested in the left side of the curve. So it's on the negative side. Everything is on the left, right? And of course, last but not least, you multiply by portfolio value, right? So this VAR is per unit. So based on portfolio value, maybe it's 1 million, you multiply by 1 million, and that's how you get the VAR. Maybe I'll just pause here for a short while. Any questions? Because this calculation of VAR is important. We need to know how to calculate VAR. All good? Thank you. Okay. So we have an example to calculate the VAR in just a couple of slides. Now, just a bit of more qualitative kind of explanation. The VAR, is simple, based on a normal distribution, which is an advantage as well, but it's a disadvantage, right? So when we talk about options, when we talk about things like synthetic products or structured products, you'll realize that their payoff might not be relating to a symmetric kind of normal distribution. So we'll look at it a little bit. And because of this, right, when we have options and derivative products, perhaps the VAR might not be a good option in that case. So we cannot use the VAR measure. Of course, we rely on some assumptions, things like normal distribution. Okay, maybe a stock might not be normally distributed, right? And the return of the stock might not be normally distributed. So it might not be very accurate. You might actually underestimate some actual magnitude of losses and frequency of large losses as well. And this is relating to the normal distribution that we assume, right? Maybe in this, maybe in a certain stock, it could be a skewed kind of distribution, right? So maybe you have a skewed distribution like this, might not be a standard normal distribution. And because we assume there's a standard normal, we can't underestimate some magnitude of losses, right? So skewed meaning that you see here, we have a lot of loss. All right, so just this is a kind of an informal example. Would you invest in, if you have 100,000, sorry, no, 10,000 in financial asset, which one will you invest in? If you lose money 1 out of 3, or if you lost at least 1,000 out of 1 year out of 10 years. Before we look at the kind of like a bit of explanation here, anyone want to try give a guess? Just based on your understanding of VAR. Yeah, okay, I see it. Yeah, sounds lesser. Yeah, you're right. So your intuition is right. 1 out of 3 sounds lesser, right? Compared to at least 1,000 in 1 out of 10. Okay, so this is kind of the returns in the Straits Times Index, right? And they give you further a bit more information in terms of the annualized return and standard deviation here. Okay, but this is a very informal example. So the idea is that if we want to use the concept of the VAR, we would use the non-standard inverse. Basically, we want to determine, let me just draw the normal distribution because I think it's easier to understand from here. Okay, we want to determine this portion here, which is given by 0.33 versus, and the portion here given by 10%, right? So 10% would be somewhere here, right? 0.1. So we want to determine what are the losses here, what are the losses like here. So this is an informal example. Let's look at a proper example now, right? With the values and with the values given and how do we do a calculation. Okay. So we have an analyst here who would like to know the VAR of a portfolio consisting of 2 assets. Long-term government bond issued in United States and a long-term government bond issued in UK. The expected monthly, so this is a monthly return on the US bond is 0.85. Standard deviation is 3.2. The expected return now on the UK bond, US dollar, is 0.95. Standard deviation is 5.26. Now, we know that whenever we have a 2 asset portfolio, we need to consider the correlation, right? This is way back in our so-called lecture 2 or even back in FIN 203. We need to consider correlation whenever we think about portfolios. So we understand that the correlation between the two assets is 0.35. The portfolio market value is 100 million and it is equally weighted. So we're expecting 50-50 from each asset class. So using the variance covariance method or the VAR method, compute the 5% monthly and weekly. So there are two parts here. We need to consider the monthly portion and the weekly portion of VAR. And recall that I mentioned in a VAR case, we are not able to compare VARs with different time periods. So in case you do receive a question in your assignment or even in your final exam, if they give you different VARs with different periods, please make sure to convert them to a same period. So if it's monthly, convert them to weekly, right? Convert everything to weekly, do the comparison from there. And do not compare monthly VAR with weekly VAR. Because, and we can see in this example, it does not make sense at all. Right? So in this case, given that we are considering a portfolio, we first consider the expected return of the portfolio given at 50% each for each asset, as you can see here, right? And then we consider the monthly variance. So this one I will not go through because this is way back in is using the variance formula in lecture 2 or in FIN 203. So if you can't remember this formula, please go through it again. And then, of course, we know once you calculate portfolio variance, standard deviation is simply just a square root of the variance, right? So now that we have the expected return of our portfolio and the standard deviation of portfolio, we can tackle the VAR question already, right? So first, the monthly VAR at 5%. So we know that the formula for monthly VAR is a negative of the expected return, which is given here, minus, now at a 5%, we need to do the inverse standard norm, right? Because the VAR assumes a standard normal. So we use the inverse standard norm in Excel to give you 1.65. We add in the standard deviation as per this formula of VAR, and we add in the portfolio amount, which is 100 million. We determine this is the value at risk, right? So basically what it means is this is the minimum amount of, so let's try to understand the concept. So yes, we calculate VAR. So what does this mean? It means this is the minimum amount that you will lose on a monthly basis at a 5% confidence, 5% level for this portfolio, right? So it can be, so remember it's the minimum. So I can lose, 10 million, but the minimum is 4.95 million that I'll lose on a bad month. All right. So now that we have tackled the monthly VAR, let's look at the weekly VAR, right? So recall that all your calculations here are based on monthly, right? That's right, or monthly, right? So whenever we want to convert that to weekly, the reason, okay, so we multiply by 12 divided by 52. The reason why we do this is it's a bit more accurate, right? Since some people might say, oh, since I have monthly already, I just divide by 4, right? I mean, we can just assume 1 month has 4 weeks. And so we just take the monthly amount, divide by 4, should give you weekly, right? You can do that. However, if you want to be more accurate, we know that in a year, there are some months that have 5 weeks, blah, blah, blah. So we multiply by 12 and then we divide by 52 because we definitely know there are 52 weeks in a year. Right, so this is a small adjustment that we can do to ensure a more accurate result. Thereafter, we can do the same thing with our standard deviation. So at this point, I want to highlight something here, right? So this goes back to your statistical concepts that you understand about standard deviation, about variance. And the idea is that we should only put the so-called the correction in terms of the base denominator, in this sense, weekly, in the variance portion here. So we need to convert the monthly variance to weekly variance first, then put the standard, and then we put the square root as given here to find the standard deviation. So you should not be taking this, the standard deviation immediately and just multiply it by 12 divided by 52. By doing this, it's wrong. Okay, so I repeat again, whenever you do a conversion in terms of monthly or yearly into weekly, and when we're working on things like standard deviation and variance, always use the variance component, right? Do the conversion in variance, then square root it at the end here in step 2, square root it to get the standard deviation, right? Any questions on this? Okay, yeah, sure. So I see a question that's directed to me. So the question is, how do we get this 1.65 here? So how we get this is we need to go to the Excel and we use the norm dot s dot inv, right? Let me just flip over to show you. So we need to use this one here, this formula to give you the 1.64. So as we kind of explained earlier, so this, why do we use this norm S inverse 0.05? Basically, we are trying to get this normal distribution. We know that 5% is inside here, 5%, right? This 5%. The area under a normal distribution graph gives you the probability, right? So we are trying to find what is this point in the graph of this normal distribution graph that will give you a 5%. And in this case, this is 1.65, right? So at this point, at 1.65 here, this area under this portion will be a 5% that we require. Okay, so how do we get this? We need to use norm.s.inv. Okay. So just read the question carefully. In a 5% bar, we use norm.s.inv bracket 5% or 0.05. If it's a 1% bar, please use the 0.01. Just a quick question. Between a 5% bar, see if you're on this, between a 5% bar and 1% bar, which one would likely have the larger bar? Okay, we have one that say 1%. Anyone like to give a try? Anyone agrees that 1%? Yeah, okay. So we can actually determine this, right? We know that a 1% bar will give you a larger z-score here. Okay, so a larger z-score multiplied by standard deviation, and then we take the expected return minus the larger z-score, we kind of get a smaller value, right? After expected return minus your z-score. However, we need to know whether your z-score times the standard deviation will give you a negative value. Okay, so let's just jump back to that question and then we see it from an example, it'll be easier. Okay, so on average, because our z-score times standard deviation would generally be bigger than what's our expected return here, right? And in this case, it means that you're right, the 1% bar would generally have a bigger bar value compared to 5%, meaning higher risk at 1% level. And we can see it here as well, right? So going back to the question, at a 5% weekly, once we are able to calculate the standard deviation here, we put the standard deviation into this formula, we put the weekly expected return into the VAR formula, and then we determine what is the VAR amount that we will lose in general. Okay. All right. So we have another method to calculate VAR using the historical method. And the idea of the historical method is, okay, let's just look at maybe 10,000 or in this case 1,000 kind of observations, right? And from there, we sort the observations based on the returns that we get. It can be a monthly or weekly kind of returns. We sort, let's say 1,000 observations. And from there, if we want a 1% or 5% bar, we determine what is the 1% of the number of observations. What is that 1% level? Okay, so that's kind of the concept. And the idea of it is like this. Okay, let me try to share with you how we kind of understand this statistically. So if we have different observations, let's say we have some observations here, basically we have 1,000 observations, right? So some here, we have some here. So we kind of like put all observations together. And the idea is that when we have a lot of observations, eventually we hope that you become like a normal distribution. So once you sort them, you will know that, oh, okay, maybe in the middle is where most of the returns are. Maybe there are some lesser returns here. So this is what's happening, right? Maybe you have something like this. So you stop your distribution, stop your returns, and you kind of get somewhat of a normal distribution. Let's drop here. Sorry. Okay, so you get somewhat like a normal distribution. And the idea is that, okay, if we have 1,000 observation, a 1% or 5% count bar using a historical method would be the 1%. Okay, for 1%, it will be the loss greater than the 10 loss that we see on the graph, on this normal distribution graph. Or the 5% would be the 50th worst loss that we observe. Right? So this is, I guess, a more rudimentary kind of method because we are just sorting all the observations. 1%, okay, what is the 10? 1,000 observation kind of situation, or 5%, which was the 50. Now, the idea is that for a historical method, while we tend to assume a normal distribution in most cases because it makes calculation easier, we can actually use a non-parametric approach. So I'm not sure, maybe just a quick poll, have you all covered non-parametric methods of calculation in your statistics course, non-parametrics? If no, then maybe I'll just do a short kind of comment. No? Okay, no. Okay, yeah, I think most statistical course will focus on your normal distribution. Now, okay, so not really. Okay, just kind of for your understanding, right? What is this? So a non-parametric method is that rather than assuming a normal distribution, we let the data create a distribution for you, right? So for example, you plot the points, you plot all the data points like this, you plot it like this, all right? We plot it something like that. Sorry, it's a bit difficult to view the points. Okay, so we plot some data points like this. And based on this, we kind of get like a, let us zoom in a bit so it's easier to see. We kind of get like a weird shape like this, right? And this is a non-parametric approach. So we are going to take this shape and assume that the data is going to have this shape, right? There is no name for this shape, but it's going to be this shape. And by doing this, we can kind of, you know, uh, determine the var by not forcing the data into a normal distribution, right? So what if the data is this shape, like this, is definitely not a normal distribution, so we shouldn't force it. So using a historical method, because we have the data points, we do not assume a distribution, we can actually do a non-parametric approach in our calculation of R. Okay, so your normal distribution basically is called a parametric approach. So parametric means you parameterize your data by assuming a distribution so that you can do calculations much easier. There's a bit of understanding. Now, of course, a historical method, the biggest criticism is that, you know, a stock market, the stock prices, the past might not actually reflect what's happening in the future, right? So, you know, like if you look at stock market now, there's a lot of exuberance in tech stocks, and we are kind of in a stagflation kind of situation, which is very unique because this is the first time in history where we are in a stagflation slash soft landing slash recession. However, stocks are doing so well, right? Normally that's not the case. So in this aspect, you know, the history might not actually prevail in the present, right? Historical data might not be true. And this is one of the largest criticism of the historical method. Uh, Next, bonds and derivatives also act very differently in terms of the life of the asset. We know that for bonds, we need to consider the convexity of the bond. We talked about it quite a bit in the last few lectures. The convexity meaning as the life of the bond progresses, we see a concavity of the bond, whether is it, okay, I'm just going to do a small recap. We know that in a standard bond yield curve, we see view like this, and we see a concavity of the bond, and this is the portion where the concavity happens, right? This is the portion here, right? We talked about it quite in detail in lecture, I think lecture 2. And so this aspect of the, let's say, the long-term bond would impact the values if you use a historical method to determine the bar. Um, Moving on to the next method is a more of a kind of Monte Carlo simulation. So a bit fancy word, but in layman terms, basically what you're doing is you repeat the simulation of, it can be anything, but in this case, we are repeating a simulation of a VAR multiple times using a scenario called analysis. Okay, not really scenario analysis, but using a probability model. And from there, we determine the full range of value that is possible based on the parameters that you have set. Once you determine the full range, the idea is that once you have a full range, hopefully you reach a normal distribution. Okay, almost goes like normal distribution, right? So once you have a full range of simulation, you eventually reach a normal distribution, and from there we can use the same method to calculate the bar based on the normal distribution, right? So that's the Monte Carlo simulation approach. You to simulate the full range of values, and hopefully this full range of values give you a normal distribution, and from there we can determine the bar. So the simulation, the method of simulation, that is called the Monte Carlo simulation. Okay. So let's look at an example here. Consider a 10 million portfolio of stocks. And we have performed a Monte Carlo simulation, right, to estimate the bar. And like what I mentioned, the Monte Carlo simulation kind of produces, what's this? 700 random outcomes based on various probabilities. Based on the 700 random outcomes, we know that the annual expected return is 14.8%, the standard deviation is 20.5%. And we have in this question, you are given the 40 worst outcome out of the 700, right? And now we want to compute the 5% VAR and 1% VAR. Recall, remember, VAR is a value at risk, right? So we are looking at the tail end of a standard normal. So I'm just going to draw this again on visualization. So the reason why we're interested in 40 worst outcome is because remember the VAR, what we're interested in, we are interested in this tail end risk, right? So the 40 worst outcome would likely be situated here, right? Here are the outcomes. So we're interested in this portion here, right? So it's not the 40 best, but it's the 40 worst outcome. And we can see the outcomes here that has already been nicely, arranged. This is the worst outcome, negative 0.4, and this is the least worst outcome, right? At negative 0.21. Okay. At a 5% VAR, so this question is, let's calculate the VAR. So at a 5% annual VAR, we have 700 outcomes based on our Monte Carlo simulation. A 5% VAR means you take 700 times 5% to give you the 35 worst outcome, right? So at 5% VAR, we're looking at the 35th worst outcome. And so let's go back to our data here to look at which points is the 35th worst outcome. Now, we know that this is the 40th, right? Each row is 10. There are 10 outcomes here. 10, 20, 30, to 31, 32, 33, 34, 35. Okay. So this is our 35th worst outcome, which is 0.223. And this is what we see here. This one, there's a small typo. Please add the 3 here. It's missing. And so we have determined the VAR of the 35th worst outcome given by here. And we just simply multiply it by the portfolio value of 10. Right? So in this case, we don't really need to use the VAR formula because the Monte Carlo simulation has already given you the VAR. Right? So we just determine what's the value of it. So we multiply by 10 million and we just get the answer here. Now, in a 1% VAR case, we do the same thing. We take 700 outcomes times 1%, right? And this gives you the 7th worst outcome. Now, going back to the example here, the returns, let's look at the 7th worst outcome. So 1, 2, 3, 4, 5, 6, 7. So we are interested in this outcome here, 0.347, right? And this is what we do, and we multiply it by 10 million. Any questions so far? I'll just give a short pause this example here. Good, it's clear, it's good. Okay. No, we're good. Perfect. That's good. Okay, so let's understand some limitations of the VAR. So often it underestimates the magnitude and frequency. We kind of talk about it of the worst case. We can kind of avoid this by doing some back testing. So, if you're interested in financial modeling, back testing is a key component of what you usually do. You back test to make sure that whatever is in the historical data kind of is able to predict the future, right? That it still holds true. Individual VAR position do not aggregate simply. Remember, I told you that for VAR, we really need to compare the same, either the same period, and you cannot just add the VAR together. It doesn't make sense, right? When you look at the calculations, you can't say I want to add 5% VAR to 1% VAR. Does that make it doesn't? There's no mathematical sense in adding VAR. It fails to incorporate the positive results. Of course, if you notice the bar, what we have been always talking about is our left tail of our normal distribution, right? Of course, our left tail is the worst case kind of situation. We do not consider some upside situation. But this does not provide a full picture of the stock. Yeah. All right. So now we are going to take a more macro view on how do we actually manage um, market risk in general, right? So there are few kind of commentaries on how we manage market risk. We can do some kind of risk budgeting, right? So risk budgeting is, we kind of like say, oh, what's the likelihood of losses based on this product? And we set aside certain, let's say, set aside certain things, we call it risk-weighted asset. We set aside certain asset to make sure that we can able cover the losses in a situation where we experience a loss, right? So some risk budgeting. We have the bar that we talked about. We do a bit of things like stress testing. So stress testing, basically, the idea is that, let's say, on a normal case, when we look at a portfolio, we always consider a 5% bar, right, on a portfolio. Now, let's do a stress test to consider a 1% bar or maybe even a 3% bar. And as we know, the smaller the percentage, meaning that we are looking at more of the extreme side of the normal distribution. So let's say 5% is here, 5%. Now, if a 1% is here, we're looking at more of the extreme end. And because we're looking, as we move on to the extreme, the losses are bigger, right? So we do a bit of a stress test on this case. We can do a scenario analysis as well. Scenario analysis means that what happens in a recession case? Would our bar increase dramatically? We do some kind of different scenario, or let's say if we have a soft landing, right? If it's soft landing, what is our VAR that we experience? So we have maybe 2 or 3 cases, or let's say if we have a recession, so what's our kind of worst case? And this kind of links to the scenario analysis as well. You can perform a stop up, meaning that if a portfolio reach a certain level that is beyond what we expect, we stop the portfolio. Whether we liquidate it to get immediate cash, or we just stop. We stop trading or we stop doing rebalancing, which we're going to talk about in a little bit. Right? So we just stop. Position for maximum concentration limit, basically we want to reduce concentration risk, right? So the traditional form of reducing concentration risk could be simply, reduce the amount of stocks in that portfolio, right? Let's say we have Apple stocks. We want to reduce the number of Apple stocks in a portfolio, and this will reduce concentration risk. However, I want to challenge you to think a bit deeper. This kind of thing. Are we able to reduce concentration risk by not actually tackling the underlying of the stocks? Meaning what? Do not reduce the stocks in our portfolio, but we are able to reduce concentration risk. So try to think about this. We will talk about it later in risk management in the next part of our lecture. But are we able to do that? And hopefully you can see that there's actually ways to manage your portfolio by not actually trading the underlying, not changing the stock, not so-called reducing the number of stocks or increasing the number of stocks in our portfolio, but still reducing concentration risk, right? So that's where we use our derivative products, where it comes in handy. Leverage limits, basically, are we maximizing or are we using a lot of leverage? Recall that we talk about things like short selling. Remember, short selling is kind of a leverage position because you short sell, but you might not have underlying, right? So a short sell position takes on leverage, and if you're taking too much leverage, there's higher risk in that sense. A bit more comment on credit risk. Just do a quick one. You can have a look at it again on your free time. Basically, credit risk, as we mentioned, is the risk of the counterparty not being able to pay up. there's this comment here that over-the-counter derivative does not have explicit credit guarantees, and we have to evaluate the credit risk of a forward swaps and options. So basically, what's this talking about? It means that when we think about derivative products, so this is a kind of a transition to derivatives already, is that derivative products most of the time do not have the underlying. When I say underlying means the stock or the yeah, mostly the stock or the bonds, can be ETF bonds as well. It does not have the underlying, right? You are basically trading the derived value of those underlying products, right? So because of that, there's no credit guarantee. You do not have a guarantee on the underlying, and hence this introduces some credit risk um, into our discussion. Of course, when we have a credit risk situation, we need to understand what's the probability of default and what is the amount that you can recover, right? So yes, okay, let's say you say that probability of default for a counterparty of this, let's say Apple, right? Super big. Here the default probability is 0.1%. It's very slim. However, if the default really happens, how much can we recover from Apple? Perhaps we can recover a lot. Maybe they have a lot of cash flows, they have a lot of assets that they can sell, so we can recover a lot. So this, we have a high probability of default, however, recovery rate is high as well. Sorry, we have low probability of default, but recovery rate is high. Uh, Credit risk events are usually very rare, I would say. However, when a credit risk event happens, the key topic that we need to think about is, are there contagion or contagion? Contagion meaning, would one credit risk event trigger other credit risk event in the market, right? So for example, um, we have in last year we had a few bank credit risk event, banking related credit risk event or financial industry credit risk event. And one of them is Credit Suisse, right, which went bankrupt. And so, and then we have Signature Bank as well. And so the key topic that was on most analysts' mind at that point of time was, is there a contagion between Signature Bank and Credit Suisse? Would this cause a banking collapse in the financial industry, right? So this aspect of credit risk is important to consider, right? Is there any contagion effect when a credit risk situation happens, right? So by doing so, we need to consider the correlation between the two assets. Okay, so I think now is a perfect time. As usual, we will take two breaks. Now is a good time to take the break before we jump into using derivative products to manage risk. Let's take a quick, 7 minutes break. We can come back at 8:02. That's good. If you do have any question, put in the group chat, and we can discuss it when we're back from the break. All right, welcome back from the short break. So, just before we went off the break, we kind of really discussed more on the concept of risk, and we kind of try to understand what is risk in terms of more statistical kind of approach to risk, particularly on the bar. Now, now we want to move on to more risk management, right? And because we are in a portfolio management, a finance kind of course, we want to use things like derivative products to manage our risk for us. So let's understand what is the basic um, derivative product first, right? And the most basic form of a derivative is your forward. Okay, so what's a forward? As I mentioned, as the name kind of suggests, a forward basically says that, okay, I want to buy something in the future, right? At a set price, at a set date. Now, in a forward contract, what happens is that there is no cash outflow at the start, and there's no cash going in and out until the end of the forward contract. So a forward is basically just a piece of paper, a contract between you and the forward seller. And the idea is that you set a price, you set a maturity date, and that is the amount that you have to transact at that point of time, right? So from a risk, credit risk perspective, if why do you want to buy a forward? Anyone would like to give a try to suggest from a credit risk perspective, why do you want to buy a forward in this case? Lock in the price, that's good. Okay. That's right. You have a price expectation, right? And hopefully, obviously, you want to avoid a credit risk situation where, let's say, the counterparty goes bankrupt, right? We want to avoid that. But in case that happens, by locking in a price of a forward ahead of time, we kind of protect ourselves from a credit risk situation where the price, let's say, drop dramatically because the counterparty goes bankrupt. The counterparty is not profitable, right? So it reduces our risk. So kind of like a risk management approach, right? Um, and the good thing about forward, of course, like I mentioned, there's no cash outflow at the start, and the transaction happens at the end. So prior to expiry, there's actually no risk that really exists, credit risk that exists. But of course, there is a potential risk at the end whether the person can pay you, the forward seller can pay you, right? For example, if you buy Apple, a forward for Apple, let's just say, and you say the price for Apple, forward for Apple is 190. You know that Apple is trading around 170 now, right? So in case the situation where Apple really goes bankrupt, the stock price drops from the current value of 170 to let's say 50, right? It drops dramatically. Maybe the forward seller, basically the person that's selling you the forward, might not be able to even pay you, right? So that's where the credit risk um, happens at the expiry. And of course, you know that the forward seller is not Apple by itself. It is usually, a fund house. It is a derivative house that actually creates the product for you. This so-called paper product. So in this case, there's some risk at the expiration date. Some motivations, you do not want to pay for the transaction now. And of course, you want to lock in a price, as mentioned earlier, right? You have a view of the price movement, you want to lock it in, you reduce your risk of price moving out of your expectations. Now, the forward is the most simple example of a derivative product. Now, moving on to the second level is swaps. So what are swaps? So this is something I want to highlight. Swaps is simply a series of forward contracts. So it's just a forward contract that you start together. And the idea of a swap happens is you are actually swapping certain characteristics. Yeah, it can be credit risk, it can be swapping currencies, you can swap a lot of things, right? Basically, we are swapping certain elements based on the rules of how long the stock would last, what are you swapping from one party to the other, right? So we are swapping basically things. Um, and there's some defined rules again because a swap is a series of forward contracts. It's basically just an agreement between two parties. There is no cash upfront that's been paid in a swap situation. However, there's one swap that there will be a change, there will be a sum of payment at the start. And this is the currency swap. Because in a currency swap situation, basically you are swapping the currencies, right? For example, Canada, I want I want Singapore dollars, I do a swap with you, right? And then they require a swap in notional amount so that you have the currency to do whatever you want, right? Whether it's a project, etc. So in the currency swap, that's the one of the situation where a swap actually has some cash upfront payment at the inception of the swap, right? But in most other cases, there's no cash upfront, right? Because the swap is simply a series of forward contract. I put another star here because this really helps you understand what a swap is. It's just forward contract, but in various multiple forward contracts. Okay. We have things like we'll go in details on the different type of swaps, but we have this thing called interest rate swap as well, which allows you to swap between a floating to fixed or fixed to floating rates. And we can do it for liabilities, and we can do it for investments, meaning assets, right? So assets and liabilities can be swapped. So let's look at an example of a interest rate swap here. Now we have two companies. We have Intel and Microsoft. Now let's focus on the portion of Microsoft here. Okay, Microsoft. So Microsoft borrowed some money from somebody here, right? Borrowed from this person X, agrees that when they borrow the money, Microsoft will have to pay LIBOR plus 0.1%. Right? This is what Microsoft has to pay to a party that he or she borrowed money from. Now, okay, Microsoft doesn't want to pay a floating, right? Because we know LIBOR is a floating rate. So Microsoft doesn't want to pay LIBOR. Microsoft wants to pay a fixed amount. So what does Microsoft do? It enters into a swap agreement with Intel. It agrees to pay 5% to Intel, and Intel will in turn pay LIBOR to Microsoft. So if you can see here what is happening, your LIBOR is going through from Intel to Microsoft and eventually to party X, which is what Microsoft is borrowing from. And so there's a pass-through of LIBOR, meaning that on a net basis, Microsoft is simply paying 5% here plus 0.1%. And so in this case, we have created a interest rate swap from floating to fixed. I'll pause here for a while. Any questions regarding this, the basis of how swap work, and in this case, interest rate swap? So as you kind of think about it, right? Recall that in almost every lecture I'll mention that whatever you learn in the various lectures are basically tools that allow you to consider certain portfolio management aspect, right? So in this case, we're really focusing on risk management, but they are basically tools. You're not expected to always do an interest rate swap for your client. You can or cannot do it, but based on the client needs, for example, a client say, I've been very worried about the fluctuation of interest rate. Maybe the Fed would cut interest rate, right? And I'm worried that my investment, might not be worth too much. let's say it's a mortgage payment, right? And so if your client has mentioned such concerns, as a portfolio manager, the idea is that with these tools that you have learned in this course, hopefully you can realize that, hey, you know what? If my client is worried about fluctuating interest rate, perhaps something I can do with him is to create a interest rate swap, right? So I hope you can see that whatever we have covered is really tools to assist you to help your client in a situation, to help assist your client when he has a concern. Okay, we are clear for interest rate swap. Now let's look at the other end of the swap, right? So a swap always has two parties, right? So let's think about on the side of Intel. Now, Intel, in this case, borrowed from W here, W, some counterparty, and Intel is paying a fixed rate, right? 5.2%. Now, as he has entered a swap with Microsoft and is paying Microsoft LIBOR, and Microsoft is in turn paying Intel 5%, on a net basis, what's happening? Your 5% becomes a pass-through, where Microsoft pay 5% to Intel, Intel pay 5% to W, and on net basis, Intel simply has to pay LIBOR plus 0.2. This is the net amount that Intel has to pay because you have a 5% pass-through from Microsoft Intel to W. And so what Intel has received is now Intel is paying a floating rate and not a fixed rate. Okay, so that's the interest rate swap. Now let's think about a equity swap. So in an equity swap situation, let's think about a client. Say a client has a portfolio of equities, maybe the S&P 500, right? So our client has S&P 500 and she's getting S&P 500 every month, right? S&P 500 returns. However, maybe your client say, my view of equity market is very dim. I feel that equity market will not be doing too well in the next year. How about I enter into equity swap to receive a fixed rate of 9.95% instead of getting a S&P 500 return. And so this is your client. And what you do is you enter into a swap agreement with a swap dealer to pass through the S&P 500 return from your client to the swap party and have an agreement with the swap party or the swap dealer to pay you 9.95. Once this is set up, at the end of the day, your client, Mandy, will be simply receiving 9.95% per annum instead of S&P 500. Okay, so this is a simple example of equity swap. We can do a currency swap as well, right? A currency swap is quite common in the sense that most of the time, whenever we buy a portfolio of a diversified portfolio of assets, we have assets coming from different jurisdictions, different countries, right? And so we might need to do some kind of currency swap to reduce our currency risk. And so in this case, in this example, we have a British company called Rotex, a British high-tech company, right? And the British high-tech company wants to invest in Europe. And we know that in UK, in Britain, using pounds, right? But in all the rest of Europe, European Union in particular, we are using the euros. So what does Rotec do? So Rotec has very limited experience in the European market to issue bonds, but is very well known in the UK market to issue bonds. So what Rotec does is that Rotec, try to issue a bond in UK, right? It issues a 30 million bond in UK. It gets the amount in pounds, 30 million pounds. Now, it enters because it wants to expand in Europe, right? So it enters in a swap agreement with a swap banker, right? Where it will give the 30 million pounds to the swap party, and the party itself will give a euro equivalent based on the agreement in the swap to rotate, right? So in this example of a currency swap, we see that there's an immediate swapping or changing of money from one hand to the other. So we're talking about a notional change in the because we need the currency amount, right? We need the money, right, to do your investments in Europe. So there's a physical change at the inception of a swap. Now with the euro that Rotec has, it's able to invest in Europe. So why is okay? Question: Why is for currency situation? Why is using a currency swap better than just simply going to a money exchanger to say, okay, I have a 30 million pounds, and I just go change it the money and a money changer to euro. And you want to like give a try? Why is a currency swap better than just using a standard money changer? Okay, those are valid points. Yes, the rates might be better, safer, faster. Maybe the notional amount is quite big as well. The margins, okay. You not lose on the amount you earn for interest. Okay, what does that mean? Interest, because this is a swap situation. What kind of interest are you referring to? Okay, investment gain. Yeah, that's possible too. But one of the key things I want to highlight in this why a currency swap is better is recall that whenever you're issuing a bond, you are talking about a bond, meaning that you again have to return the money to your bond holders, right? So your swap has to close. So when you close the swap position, you have to reverse what you do. And in a swap situation, in case I think one of you mentioned is safer and all right. That's true because in case there is a fluctuation, drastic fluctuation in interest rate, not interest rate, sorry, currency rates, because you are in a swap position, the amount that you need to pay to get back your pounds, 30 million pounds, is already set in the contract. So there is no worry that suddenly you have to pay a lot more. You can kind of manage risk because remember we are in a situation of risk management. We can kind of manage risk by knowing that okay, you know what? I know for sure I just need to pay this to get back my 30 million pounds in order to pay back my bond holders. And that's all. Right? It gives us certainty, it reduces the FX risk that we are trying to mitigate. And recall that in a when there's a bond issuance, right? We're talking about a bond issuance for 10 years, right? We're not talking about 1 year, 2 years kind of situation. Then in 10 years, FX can change a lot. Your currency rates can change a lot. So in a swap situation, you can't protect yourself against any FX risk. And particularly when you close the swap position with the swap party. Okay, hope that is clear why we want to use a currency swap instead of doing a money changer in the market. Okay. Now, in a swap, in general, the swap has different life, right? The beginning of the swap, the middle of the swap, and the end of the swap. Now, in terms of the credit risk is usually the smallest at the beginning of swap. Why? It's because before we enter a swap in a swap agreement, right? Remember, a swap is just a series of forward contracts. Before we enter in this swap agreement, both parties will do a lot of credit risk analysis. They'll, make sure that the parties are will not go bankrupt in the near future. And so, because all this risk analysis is being done, your credit risk is very low at the start. Now, at the end, let's think about at end first, right? At the end of the swap, recall that in a swap is a series of forwards, right? And forward each forward has a maturity, right? A swap is just a series of forward. So at each maturity, maybe there's a payout, maybe there is some change in notional amount that happens, right? Because it's a series of forward. And because of that, there are some cash flows happening. But at the end of a swap life, there is no more cash flows, or maybe there's one or two more cash flows that's going to happen before the swap ends. So because of that, most of the credit risk of non-payment of the cash flows has already happened. So we are not concerned about the credit risk, so-called the we can even use value at risk, right? The amount that is at risk is very little at the end of a swap life. Now, the problem comes in when it's in the middle of a swap. Because in the middle of a swap, remember, a swap can be 10 years, 30 years swap. In the middle of the swap, that's where things can change, right? Maybe the company do a divestment, maybe they do a M&A, or they do a new investment into a developing country in Africa. And because of these change in dynamics, there can be a sudden shift in whether the party can still pay up the swap cash flows as required on a yearly basis, right? And because of this caused a lot of issues, whether these credit risk issues, whether the counterparty can maintain a swap position. And so in the middle life of a swap, that's where your credit risk is the highest. Okay. Now, so about swaps. So we kind of understand how swaps can be used to manage risk, uh, credit risk. We can swap, S&P 500. We can swap currencies. Yeah, we can swap almost anything, right? Now, let's think about options. How we use options instead. So, wait, Paul, have you all covered options in other modules, or is this the first time you have ever seen options? First time? Have okay, maybe a mix. Some is first time, other have okay, other module, okay. Okay, maybe more of okay, most of you are have seen it. Okay, okay. So let's try to do a hybrid, right? Like I'll try to explain options as well. But for those that who know, I'll try to push a little more and we try to understand more different kind of options that we have. So in the option market, we have two kind of options, American options and European options. And the difference between American options and European options is that American options can be exercised anytime, right? Anytime, even before expiry. Now, because of that, we have credit risk at all periods of our options, all time periods of options, because they can exercise early, they can exercise tomorrow, etc. Now, in a European option, you can only exercise it at expiry date, meaning that there's actually no credit risk or no significant credit risk throughout the life of option until the time of expiry. Okay, so in all our cases, when we study, most of the time we focus on European option because there's more interesting. There's more things to talk about because there is a cut-off. We know that at this point there's a risk level that's going to increase, blah, 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 which we're going to talk about in just the next slide. And so we always focus on European option. However, the concept option can be applied for American as well. It's just that for European, there is a bit more. Yes, Singapore, there's options as well. Okay. So there's a small comment here. If the short declares bankrupt before expiry, the long can claim on the option value. So, this maybe might not make much sense now, but let's look at the option payout structure. Then we can understand what is a long, what is a short. Okay. So what we see here is the vanilla options, right? So we have a long call. Okay, so we have two kind of options first. Let's look at it. We have a call option and a put option. Okay, and how do I remember it? So the difference is this. Let's think of put option first. Put option is how I remember is you put the item there to sell. Okay, I repeat again. A put option means you put the item there to sell. So what does this option gives you? It means that you have the ability to sell that underlying at a given price. You put to sell, right? Put option is to put there to sell. Now, call option is to option to buy. You call it back. That's how I remember. So call option to buy and put is to put there to sell. All right. So that's the two card options first. Now let's think about what do you do with the option. Okay. First, when we think about long means you are buying the option. Short means you are the one that is selling the option. Long is to buy, short is to sell. Okay. So in this case, let's look at the first situation here. I want to long a call. So I'm longing, that means I'm buying the call option, and the call is to buy a stock, right? A call option is to buy. So you're long the option to buy the stock, meaning what? If your strike price of the option, strike price meaning you're going to buy the stock at this price, right? Buy the option at this price. So if your strike price is here, and your stock price after you strike the strike price of option, after you strike increases, right? The stock price increases, underlying increases. Your option value increases, right? Because you are going to buy, let's say, at $50 here. Let's just assume $50. Now, if your increase beyond 50, you're going to make a gain. This makes sense, right? That's why your payoff structure, we see a gain, right? This is 0. You see a gain after the strike of 50, right? Because remember, a long call is to buy a stock and you're longing the position. That means you hold the position. Okay, now let's look at a long put. A long put position means what? You are putting the okay, put first is to sell, right? So you're going to sell it at a strike price of, let's say, $50 here. Okay, and when you long a put, what happens? If you're going to sell at $50, now if the stock decrease in price, let's say $30, you're still going to sell at $50, right? Because your strike is at 50. So you're going to make a profit, right? Which is why you see a payoff comes a profit here. Right? So a long put is you want to hold that position to sell, right? The option to sell. So hold the option to sell the stock in the future. Okay. So that's why you see a payoff like this. Now let's go to the short position now. Okay. First we look at the short call position. Short means you are not even you want to hold the option. You're going to short it, right? You're going to sell the option. That's right. You're going to sell the call position. The call position is to buy, right? The call position is to buy. So when you short the call position, what's happening here? If you are shorting at, let's say, $50, now if the price increase beyond $50, because you're shorting the position, you're making losses now, right? Can you see you're making losses already because you're shorting the position? You're going to sell, but the price increase, and because you're shorting, you are making losses. In a short put position, what's happening? So you put is to sell the underlying, right? But when you are going to short a put position, what's happening? So it's if you are if your short price of a put is at 50, since you're shorting the put, it's the reverse, right? If the price drop like this, since you're in a short position, you are going to experience a loss. Okay, I'll pause here. Any questions regarding the basic of option, because we need to really understand this before we can move on to more interesting ways of understanding options. Any comments, any questions regarding options? No? Okay, okay. No comments? Okay. Now, so for options, right, based on the requirement of the course, that's all you kind of need to know about options. But usually, like what I like to cover is slightly more than the vanilla option, because the vanilla options doesn't really explain how do you create risk management out of vanilla options, right? Does it? It's not very clear. Okay, so you have options. So what? Doesn't really elaborate on how you actually uh, manage risk based on this. So I'm just going to jump to my OneNote, and then we will use the OneNote to kind of explain other kind of options. All right. Okay. Other kind of options by using. Give me a moment. Okay. By using what we have understood about vanilla options. Okay. All right. So in your you have your notes in front of you, right? Hopefully you do. But you have your notes in front of you. So the idea is that you have the the vanilla options payoff structure, right? So now, okay, I understand it's a bit difficult to understand if you have not taken other finance module. Don't worry, you can rewatch the lecture to kind of really understand what options mean. Now, we are going to cover a little more. Again, I mentioned it's not really covered or not really required in the course. However, I feel that it really kind of make you understand how options are being used for risk management. Okay, so let's think about this thing called covered call position, right? So what's a covered call? So we have our vanilla call options that we talked about earlier. Now, a covered call means that it's a stop plus a short call position. So the idea of why we want to do this is recall that in a short call position, what is the payoff like? The payoff is like this, right? The short call position is like this. Now, in a stock, what is the payoff like? Like this, right? It's just straight. You just keep on getting money, right? That's all. You just keep on getting money. That's about it. So, in a risk management approach, what we're trying to do, if we combine a stock, let's say we combine a stock here with a short call position, the payoff that we're going to get here now, okay, it's like this. Can you see? Can you see when we combine both graphs on top of each other, what we're getting is, because this is flat, so this component is flat, right? But this is going up, right? So we get up, and this is going down, and this is going up. They negate each other, they cut each other. We are getting a flat. So eventually, a covered call position gives you this. Now, question. Um, and maybe those that have taken your other modules that have covered options. Now, you might know this answer, so hopefully you can answer. The question is, why will you do a covered call position? Hedging? Okay, but that doesn't really explain what are you trying to hedge? So the question is, why will you do a covered call position? Okay, limit gain and losses. You are getting that. Yeah, you're right. There's limited gains and limited losses. You're right. Okay. Um, what other things? There's one thing that's very interesting about a neutral market can gain. Okay, that's true. That's true. It doesn't hedge if the price go down, right? Because if the price go down, it goes to zero. It doesn't really hedge that small amount of downside. Okay, we kind of understand there's about downside. Okay, because you are capping your upside gain, your maximum gain is here, right? Your maximum gain is here. You cannot. There's no unlimited upside. Hedge against volatility. Okay. Uh, yes, I guess there is. You manage both the downside, upside, right? You hedge against the volatility. Now, I want to kind of push a bit in the sense that okay, can we do a long call position? Isn't a long call better, right? A long. Remember what's a long call? So in a long call position, what we're getting is this, right? A long call position. This is a long call. So we have upside gain, and then we limit the loss as well. It's so good, right? A long call position. So the idea is yes, okay, your covered call kind of protects you. Now, but what's interesting about covered call is this. Let's look at this. You are actually shorting a call and longing a stop. Remember what happens when you short a call? When you are shorting a call, you're getting money, right? You're getting money when you short something. You're shorting something, and you're using this money to buy a stock. So what is happening? This is actually a very good income strategy where there is no cash upfront to buy the stock because you're using a short call position to cover the stock price, the stock they're going to buy. Right. So in this sense, right, there is no cash outflow at the start because you short the call to buy the stock. That's clear, right? However, because you are shorting the call to buy the stock, there is some limit to your gain, right? You limit your gain here. Yes, there's a bit of leverage involved. You're right. There's leverage because you're shorting the call to buy a stock, meaning that you don't have to pay anything, or you get some gains, but your gains are limited. Yeah, no loss, no gains, right? You're right. So if you are, you know, you want to do a covered call position, you don't want to fork out money, you take a leverage by shorting a call to buy a stock, you limit your gains, right? You are not putting cash up front to buy a stock, which is unlimited gains, right? Remember, if you buy a stock, it's unlimited gains here. Okay, so this is one so-called additional thing I want to talk about. Now let's talk about another one. Okay, so I want to talk about this thing called protective put position. So what's a protective put? A protective put is the same as like almost like covered call, but basically what you long a stock plus long a. So you long a stock and long a put. So for stock, we know that we get a return like this. When we long a put, what do we get? Remember a long put position, we are getting a, sorry. When you long a put, we get a position like this, right? When we aggregate both of them, when we long a call and long a put, what do we get? We have a position like this, right? Which is like a long call position. So in this sense, a protective put, you know, kind of protects you from the downside risk here of owning a stock by putting a put position. And but the good thing is that you still have unlimited gains. Yeah, I see a comment, the right to buy a stock at a stated price. Yeah. So a protective put position basically protects your stock because it limits the loss. However, you need to long a put. And I want to highlight the issue with a long put position. A long put position requires money, right? Remember, when you're longing a position, you need money. And a long put position is expensive. I put three uh, money sign because it's expensive. So a long put position is quite expensive. And protection, in this case, is not cheap. So in the finance world, like one of your friends say, no loss, no gains, right? Yes, you want some protection, you want protection, but at the same time, unlimited gains, you need to pay for it. There's no choice. You have to pay, and it's expensive because you have to long approach. Okay, now we try to let's do. Uh, so there's many types of derivative products, but let's try to do one more, right? That I feel is important to cover. So now let's think about this thing called a collar collar position. So a collar position is a bit more complex. We need to long a put at x1. X1 means a strike price of 1. We short a call at x2. That means a different price. We are shorting a call at a different price. And we want to long a stock. Okay, so this is a collar. So let's see the payoff of what a collar likes. So when you long a put, your payoff is like this, right? A long position. A short call position, what's your payoff like? Like this, right? A short call. Your stock position is like this, just all the way up. Now, when we aggregate this, because we need to focus on the part that we are having different strike price, our strike will be different really. So what does this mean? It means this. When we aggregate first the so we let's aggregate the first part here, this part here, right? When it's going down, flat and up. This will give you down, flat, up, give you flat, right? The down and the up cancel each other and we have a flat. Now, the second portion here, we have a flat, flat, up. When you have flat, flat, up, it's going to go up. The last portion here, we have a flat, down, up. Because it's up, right? Flat, down, up. It's going to be flat, right? We segregate in three components. And we know that the strike price are different. So this is a strike price 1, this is a strike price 2. So what are we getting now? Can we see that we get a flat, up, flat, and this is what? This is a very good protection. Can you see that you are being protected at the bottom, which is good. There's limited loss. However, of course, there is also some capping of your upside gain. Now, I have a question. Why is this strategy good? Yes, you have limited downside, but you cap your upside as well. But why is this good? Okay. Oh, I see a short call premium can fund the long. Okay, I like that. That's good. Yeah, you can predict there is not much fluctuation. Okay, yeah, you can manage your risk, right? Because you are in the risk management, we can manage our risk by knowing that the top, I mean, is capped, but the bottom is capped as well. And the comment about the short premium can fund the long premium, this is totally correct. The short can fund the long if you already have the long stock. So this is a very good risk management. Can you see that if you're a portfolio manager, you already own the stock, your clients own the stock. Now, your clients is afraid of fluctuation in the market, right? You can actually help your client manage the risk by shorting a call and longing the put of different short price to get something like this so that you manage the risk for your client, right? You cap the downside, but you also, of course, cap the upside. And the good thing is that it is free, right? When you short the call and long the put, you're using a premium for a short call to long the put. It's free. It's free for your client, which is good. I mean, who doesn't want free things, right? So yes, you give up some upside, but if your client is worried, you can suggest a collar for them. So, for options, there are a lot of other scenarios that we can play out by combining them. So if you are, if this kind of tickles your interest in structured products, I highly encourage you, to look into other structured products in the market or even a course on structured products in the university because it's quite interesting. But unfortunately now, given the time, we are just going to stop here, and because our focus is portfolio management and more on risk management, but there are many other structured products. Some of you might know like things like spreads, right? We have straddles. So there are other structured products that are more to make money, right? To get profit, to earn money based on market fluctuation. So those will not cover because it's not risk management, but there are many of them. So if you're interested, do try to look out for a structured products course or derivative products course. There is focus totally on it, right? Okay, so let's jump back to the slides. So that's a kind of a deeper dive into options, um, so that you can really understand how options are being used to manage risk instead of just understanding options like this vanilla option, which doesn't really make so much sense of risk management. Yes, there's some element of risk management, but you can't really see it per se. So this is one of the things I like to highlight. Right. So reducing derivative risk. Now let's go back to more the qualitative component of derivative. We can do things by mitigating risk by this thing called mark to market. Mark to market, what does it mean? It means that, at certain points, like it can be mark to market for every 6 months, every week, we need to mark to market the derivative product so that we know the market value and ensure that the party has enough money to pay, right? We have some collateral meaning things like a cash pool. It can be even a physical collateral like a inventory, raw materials can be a collateral. So all these are physical things that the swap party or the derivative party can claim on in case there is some credit risk situation, right? So some collateral. We can do a netting. So what's netting? Netting means that let's say if you have multiple swaps happening, right? Can we just net off the value of the swaps? So let's say if you do a swap with a bank, let's say DBS bank, right? DBS investment bank, the DBS investment arm. So when we do a swap, DBS can actually do a netting. If you do 10 swaps, they can do a netting between all the swaps rather than you pay one swap, then you pay the other swap, and blah, blah, blah. So rather than doing that, you do a netting of the swaps. So that's possible as well to manage risk. Of course, we can go to a rating agency to rate your company. Last but not least, can do a credit default provision. Credit default provision is a provision in your contract where if a default of one subsidiary would trigger the default of all the subsidiary in a big holding company. Right? That's a credit default. And I see a comment here, options has high downside. Yeah. So it depends on what kind of options you're talking about. There might be higher downside as well. Okay. So we can do a credit default swap. A credit default swap basically is like an insurance in this case. So if you have a protection buyer, you have an asset, right, that you want to protect. Let's say you have a bond that you want to protect. You can buy a protection from the seller, and if anything happens, you get back a protection. You get back a fee, like an insurance, right? If the company go bankrupt, you just get back the money. Okay. So I think that was a good time. Let's again to take a 7 minutes break. We'll come back again at 9:02 to discuss the last part of today's lecture, which is on rebalancing. We'll take a All right, welcome back. Let's cover the last part of today's lecture on rebalancing. Right, so we have covered, the understanding of what's risk, what's VAR, measure of risk. We've talked about quite a bit on the derivative products, um, and how that can be used to manage risk for our clients. Now let's go on to the last part on rebalancing, right? So the idea, let's just think about what is rebalancing first, right? Before we go into the details, because we have three kind of rebalancing you can do and some calculations here and there. But let's just kind of think about it first. The idea of rebalancing is this, right? Let's say if we have a portfolio of S&P 500, right? We're managing S&P 500 portfolio. Now, we know that in the current market situation, tech stocks are really going very high, right? There's such a strong exuberance for tech stocks. And because of that, their value of, let's say, Meta or Nvidia is so high. And because of this, if our portfolio consists of, let's say, Meta and Nvidia, the proportion of these two stocks in our portfolio will be overshadowing the proportion of other stocks in like healthcare, in consumers, right? And so recall that as a portfolio manager, right, whatever we trade on, whatever asset allocation has to be written down and directed by the IPS, which is set between you and the client at the start of your portfolio management career or portfolio management onboarding, right? And so the thing is, if there is a tilt of such drastic change in stock prices that is tilting your portfolio to overweigh, because let's say Meta stock increased from $90 to 200. The jump is so much, your portfolio becomes overweight on tech stock and particularly Meta. And this might contravene your IPS, right? Because your IPS maybe say your maximum um, exposure to tech can only be 30%. So anything that exceeds that, you need to rebalance. And this is where we kind of understand what is rebalancing, type of rebalancing can we do, and how do we implement such rebalancing in our portfolio as a portfolio manager, right? So with that kind of overview, let's go into the details. Okay, so investor portfolio can become skewed if they do not rebalance over time. And one example is increasing stock price, right? So rebalancing is act of relocating assets. We can reallocate to different countries. You can reallocate anything, right? It's a long-term increment based on disciplined selling, and systematic kind of profit taking, right? So in kind of rebalancing, we need to have a strategy in rebalancing. And usually this is written in IPS as well, right? What's your rebalancing strategy? Okay, so the kind of strategy you need to consider is this. What, when, how are we going to rebalance? Is it calendar rebalancing, meaning that we're going to rebalance every 6 months, every quarter? Are we doing a percentage portfolio rebalancing? Or maybe we're doing a hybrid, right? So we need to understand that when we do rebalancing, when we sell stocks, when we buy stocks, or sell bonds, buy bonds, or ETFs, the the issue is that we'll incur transaction costs. We incur things like FX risk, FX costs. For example, if our clients in Singapore dollars, if you want to buy US stock, sure you can buy, but you need to do FX, right? You need to do a exchange of the Sing dollars to US dollars to buy US stocks. So, and when we do such rebalancing, when we do multiple rebalancing, we need to do a FX changes. We can incur FX risk. And so the thing is, yes, rebalancing is good. However, too much rebalancing will incur too much cost and will reduce our returns from clients. So we need to make sure that we rebalance the right amount. We rebalance based on what is written in the IPS. Okay. So general rule of rebalancing, I guess, the thing is whenever the strategic asset allocation based on your IPS is not met, it is there is some overweighing of certain sectors, then rebalancing must happen. Okay. This is to maintain a desired risk exposure based on your IPS, and so you're not taking on excessive amount of risk. Cost of rebalancing, most thing is the transaction cost. Maybe there's some bid-ask spread as well, FX kind of cost if you need to convert the currencies, if you're buying from a different market. There might be some actually tax consideration as well. When you liquidate a gains, if imagine you have a gain, you liquidate it, you need to pay gain tax, right? Capital gain tax. Of course, in Singapore, you don't have to, but a lot of other jurisdictions, you will have to pay capital gain tax. Timing also, time is required to buy the new product from the market at the same time to sell, right? So you need time to do rebalancing. And of course, whether you have cash to buy. Now, let's look at a simple example here. So we have a portfolio, the initial percentages, the SSA, strategic asset allocation, is given here. Now, the question is, do we need to rebalance? So let's look at what's happening to our portfolio. So our initial SSA is here, right? Now, what is happening? Our current SSA has changed significantly. So you just look at stocks. Stocks has decreased. Our bonds has increased a bit. And there's some change in commodities and gold as well. So what we require is now we need to do a rebalancing trade to ensure that we maintain a desired percentages, right? Back to 30%, 40%, 15%, 7.5, 7.5. So you just need to do a calculation. You can, in Excel is very fast because you just use formulas to do a rebalancing by making some trades to rebalance. This is a very simple example of rebalancing without any kind of strategy, right? There's no strategy behind the rebalancing. Now, calendar rebalancing. Okay, so now let's talk about strategy already. Yeah? So the first one is calendar rebalancing, meaning that we rebalance on a periodic basis, unrelated to any stock price movement. So, every 6 months, every quarter, we just rebalance. It does not involve any continuous monitoring because we know that just after a certain date, we just rebalance, right? However, because we are so-called forced, or the strategy is to rebalance every 6 months or quarter, we might have high rebalancing costs when maybe there's a situation that you don't have to rebalance, but because you have to do it, you have to do it like that, right? So next, when to rebalance, percentage of portfolio rebalancing. Um, so we rebalance when the asset of the portfolio is breached after a certain threshold. So this one, we are given a small little threshold here. So it can be like a plus minus 2%. So if it breaches the plus minus 2%, we have to rebalance. And this plus minus 2% is called corridor. So this is a bit more intuitive because we are using a percentage of the portfolio. So, okay, make more sense. If we breach these plus minus 2%, we rebalance accordingly. Asset value needs to be monitored, of course, to ensure that the value is within the 2%, let's just say. Alternatively, rebalance asset weight must be within acceptable range. These of course help to lower the transaction costs, provide some room for technical adjustments that's being done, and allow the portfolio manager to manage the weight of the relative illiquid asset. So now there's a combination as well. We can do a calendar and percentage of portfolio. So we combine both, where we kind of rebalance, based on either it's based on calendar or it meets certain, it breach certain corridor that we have talked about, right? The corridor, plus minus, let's say 2%. And when this happens, then we do the rebalancing. We can have an equal probability rebalancing as well. So for a specific corridor for each asset, with standard deviation, we can rebalance it based on individual asset, right? So you don't rebalance the whole portfolio. You can rebalance each asset to equally likely trigger the rebalancing, and we do the rebalancing accordingly. Of course, if you look at individual asset, the issue is that we do not consider some correlation issue, does not account for differences in the transaction costs, etc. We can do some tactical rebalancing, very similar to tactical asset allocation, where we kind of rebalance the portfolio to capitalize on certain market trends or certain environmental conditions in the market, right? So we capitalize on those kind of trends through rebalancing. And the idea is that we want to make maybe additional gains, we want to increase our returns, right? Market conditions here. Okay, so let's look at some strategy of rebalancing now. So we are examining three different strategies of rebalancing. And let's try to understand this equation here, right? So what's happening here? So so the stock value, okay, the stock value here is equal to a constant. So we'll see what the constant means. The constant can be a few numbers based on the three different rebalancing strategy, can be certain numbers, right? Times the portfolio minus the floor of the portfolio. So remember what we have. We have a portfolio, right? We have a portfolio. Now, if we determine the floor, okay, so the floor of portfolio is generally, like your risk-free asset. So regardless of how bad the environment, the market condition is, the floor is your risk-free asset that will for sure the cost will be the principal will be guaranteed to be there. That's your floor, right? Now, if you take the portfolio minus the floor, so the portfolio minus the floor here, this is basically your change in portfolio value, right? That is attributable to risk, right? You understand? Okay, you get it, right? So the portfolio value minus the floor is basically the change, the fluctuation of the portfolio that is contributed by risk factor. And your risk is generally, in this case, in this two asset class, this example, only two asset is attributable to your stocks. So you're not considering bonds, not considering real estate or all the things. This is just a rebalancing strategy of the two asset class portfolio of stocks and cash equivalent or risk-free assets. Any questions here? Of course, this formula is important. Once you understand the basis of the formula, when we go into the three rebalancing strategy, it all makes sense. Like you can like, oh, okay, why is M something? Why is it something else, right? Anyone needs me to repeat? It's okay? Perfect. Okay, then we'll move on. So having understand this formula, now we need to determine what proportion, right? So what's the proportion of the change in stock contributed by the change in the portfolio due to risk, right? So what's the proportion change? Is it a one-to-one change, meaning the portfolio increased by $10, the stock also increased by $10, or is it portfolio increased by $10 because the stock increased by $5, right? So what is the change? And this change is contributed by your M here, your M, which is your constant. So you have an M that kind of dictates the proportion of change. Okay, so first strategy, let's look at a buy and hold strategy, right? So a buy and hold strategy, as what is mentioned, you buy and hold a mix of risk-free assets, which gives you the floor, and risky assets. In this case, remember, we are only considering two asset classes, which means it's a stock. And we keep it throughout the whole period, right? So assume that the risk tolerance is directly linked to the net worth. The market changes are not used to be balanced, so meaning that you are just considering the strategy. You are not rebalancing based on market changes, market conditions, because you are just going to buy and hold, right? This strategy is a buy and hold strategy. This actually gives you a linear relationship of the portfolio value. Unlimited upside because you're just buy and hold, and a floor value. In a rising market, the risky asset will increase. Okay. So we have a graph to explain this, right? So in a buy and hold strategy, recall we're only holding two assets, a risk-free asset and a stock. Okay, let's just keep it simple. We know that the risk-free asset, regardless of how bad the market is, it'll be floored at, let's say, $40 in this case. Of course, having hold a stock or holding a stock, your stock can go unlimited upside. Okay, so this is a buy and hold strategy. Now, having this in mind, this kind of understanding that there's a floor and there's unlimited upside, let's look at the equation that we just discussed. We know that the floor is contributed by the cash equivalent value, the risk-free thing that we're holding, right? So let's not think about this first. Let's kind of understand the concept. Now, we know that the portfolio consists of only stocks, right? Because in this case, we only have two assets, stocks and risk-free. Risk-free is contributing the floor, right? Given here, which means that the portfolio change is 100% due to the change in stock. And in this whole buy and hold strategy, your M becomes 1. So M is here is equals to 1. But this M equals to 1 is not, okay, I hope you understand, it's not like I just come up with the answer 1, right? It makes sense, right? Because in the buy and hold strategy, you have two assets. Your floor is already contributed by your risk-free. And whatever change in the portfolio value, 100% of it will be due to the stock, which means M is 1. Any questions? So this is the simplest example. So this is the simplest rebalancing strategy where M equals to 1. Okay, no questions. So when would this portfolio strategy or rebalancing strategy work? So rebalancing strategy would work well, if for investors whose risk tolerance increase with the stock. Yes, for M, it's only for two elements. Yes, that's right. So in all our rebalancing strategy, we are going to only discuss two elements because that's the simplest way to understand. If you want, you can actually Google and research more on multiple asset portfolio rebalancing strategy. So the basis is to understand what is the base fundamental rebalancing strategy, and then if you want to go deeper, you can kind of research more on what if it's three asset, what if it's four asset class, right? Okay, so a buy and hold strategy is quite good, in a strong bull market, in a strong bear market, right? So when there is a trend involved, because you're going to buy and hold, right? So in bull market, you buy and hold, you get gains, right? Increase your fraction of portfolio stocks. In the bear market, you basically just um increase your proportion in risk-free, right? Which means decrease your proportion in stocks. The simplest buy and hold strategy. Now, let's think about the next strategy two, which is the constant mix strategy. So, what does this mean? Now, in a constant mix strategy, what we're trying to do is we want to maintain a percentage of each asset as a constant. So, we want to have like 10% stocks, 90% risk-free, or 90% stocks, 10% risk-free. So, we want to, and we are talking about two asset classes here. So, you want to maintain asset allocation that's based on percentages. So we rebalance. If the initial mix changes, the percentage changes, you rebalance. You buy and hold, buy low, sell high approach. So you buy low, sell high. Outperform the volatile market for a risk-free asset. You outperform for when there's a volatile market for risk-free. Continuously for investor who wants exposure risky, okay, fine, but have some protection, right? So in this case, you kind of maintain the same proportion of risk-free. Let's say if the prices of the stock is going up because it's a constant mix, you still need to rebalance by reducing the number of stocks and buying more risk-free, and therefore you can't have continue to have some downside protection. Now, the interesting thing is for constant mix strategy, for long-term uptrend or downtrend, the constant mix is not appropriate. Why? In a constant mix strategy, remember, you are trying to maintain a stock percentage. Let's say 30% stock, 30% stock, right? 70% risk-free, RF, risk-free, right? So whenever your stock breach the 30% because the stock price is going up, what you have to do? You have to sell, right? So you keep, let's say the long-term trend is keep on going up, the stock price keep on going up, you keep on having to selling to maintain the 30% stock. And what does this mean? It means that it forces you to sell the stock when it's going up, which is not good. Why? Because you're making losses, as in you are not capitalizing on the side gain of your stock because the stock keep on going up, but you keep on selling in order to maintain 30%. So it's not good when there's a constant upwards trend. Now, the same issue comes for constant mix strategy when the trend is downwards all the way. When it's downwards, remember, when it's downwards, that means you want to maintain 30% stock. And the trend of the stock goes down, you have to keep on buying more and more of the same stock in order to maintain 30%. And if you're buying a stock that's keep on going down, you're making losses, right? Because let's say you buy at $1, tomorrow it come 80 cents. You buy more. You buy 80 cents. Next day it comes 60 cents. You keep on buying. You're buying on losses. So when there's a constant trend of upwards or downwards, the constant mix strategy is very bad. So constant mix strategy is good when it's flat or a oscillating market. Oscillating, going up and down, up and down. I'll pause here for a while. Any questions, any clarification needed for constant mix strategy before we look at the graph and what does this mean in the graph? think we are good. So having understood the constant mix strategy, right? Now, we know that when the portfolio is going up, let's say, we keep on having to sell to maintain the constant mix. Which means what? The change in the portfolio value is simply due to the change in stock price, but it's less, right? Because we keep on having to sell when the price is going up. So the N becomes less than one because the change in the portfolio value is no longer 100% due to the stock price change. Yes, it's due to stock price change, but then because we keep on selling, to maintain a constant mix, it'll be less than the change in stock price. Because when we sell, remember, the idea is that when we sell the stocks, what are we buying? We're buying risk-free, right? So because of this, your N becomes less than one. And so this is explain why M is less than one. And in this case, the floor is just an assumption that floor is zero. If there's a question, it can be any number, right? This is an assumption to just kind of show you in the best way that why M is less than one. Because as the stock keep on increasing, we need to sell off the stock to buy more risk-free, and therefore the change in the portfolio value is caused by less than the stock price change. So works well when the investor has a constant relative risk aversion, meaning that we are not having a trend, right? We're not going upwards or downwards all the way. In a bull market, this is not good. In a bear market, it's not good as well because you keep on buying, in a bear market, you keep on buying stocks as it goes lower. It's a concave strategy. Why? Because when the portfolio value increase, it will increase at a decreasing rate. Why? Because remember, your portfolio value, when the stock price increase, your portfolio value increase, but then you keep on selling. So the increase in portfolio value would kind of like flatten out like this, right? It increase, but it's at a decreasing rate. So it's a concave strategy. Provides superior returns only when there's a reversal trend. So this is interesting, right? How does the reversal trend work? It means that, let's say, the stock price increase, right? The stock price increase, this is the stock price, and then it'll drop. So what does this mean? It means that when stock price increase, remember you're selling, right? Because it's increasing, you have to maintain the constant mix. And since you're selling, and when you decrease suddenly, what happens? You kind of, it's good, right? Because you already took off at the highest level, and after it decrease, doesn't really affect you. You are happy, right? So when there's a reversal trend in your in the stock, your constant mix strategy is very good. Now, think about it the other way. If the portfolio value is decreasing, you keep buying, right? You're buying. And then after it increase, so it suddenly increase. Since you already bought when it's decreasing, when it increase, the portfolio will gain a lot of money, right? So in this kind of like scenario, you can kind of understand, okay, the constant mix strategy is pretty good for oscillating market. That's what it's called, when there's an increase and decrease or reversal pattern. That's what they like to call it. Okay. The pictorial version of a constant mix strategy, like I draw earlier, is a concave strategy and it's flat because you are increasing at a decreasing rate. So maybe I'll pause for a short while here. Any questions regarding this? At the moment, very good. Okay, I hope it's very clear. So, if you are a bit unsure, maybe this is very brand new to you, do not worry. I'll post the recording. You can look through again. Um, and hopefully you can understand. If you simply drop me an email if you are not unsure. All right. Now, let's look at the last strategy. So it's the constant proportion portfolio insurance. A bit long, the CPPI. Let's call it CPPI. So the idea is that, the risk of so the value of risky asset is multiplied by, so we have this thing called a cushion, right? A cushion which investor is willing to risk. Your floor is the lowest level of wealth, the same thing. And if the portfolio reaches the floor, means all the money is in cash and cash equivalent or risk free. So this cushion thing, right? This cushion is the part that is important in this strategy, where the cushion kind of allows you to, allows your portfolio to move more than the stock. Okay, let's try to understand how does this happen. So in essence, you sell the stock when they are falling and you buy the stock when they are rising. So this is the reverse of the last strategy that we talked about, right? You sell the so in this case, you sell the stock when it's falling and buy when it's rising. So what does this mean? When the stock is rising, you're going to buy more and more stock, right? You're going to buy more and more stock. And remember, because we are doing rebalancing again, when we rebalance to buy more and more stock, what is happening to our portfolio? When our portfolio change, will because it change more than the stock change, right? The stock price change. Because when the stock price increases, we are going to buy more and more of the stock. Means our portfolio become more and more volatile than the stock. And which is why your M is equals to what? More than one, sorry. M is more than one. Because in the rebalancing case, we are selling away all our risk-free, right? We are going to sell all our risk-free here until the floor, of course, to buy more and more stocks that's rising. Okay, so this strategy, I feel is the easiest to understand, right? Because you're going to buy more as it rises, you sell as it drops. It capitalize on the price momentum uh, of stocks. Of course, it's conducive where if the investor has zero risk tolerance, if the portfolio falls to the floor, because if you have a floor, so you can't protect your investor. High risk tolerance. If your investor has high risk tolerance, um, is when the cushion is positive, right? Because now you have a small little cushion. So it outperforms when the market is strong and stable trend. So this is very good when stock prices keep on increasing. If the stock price keep on increasing and you buy, and you keep on buying, right? You buy. The more you buy, the more you get, right? Because you keep on increasing. So there's a good trend, use the CPPI. Of course, it underperforms in a volatile market, meaning that it's going up and down, up and down. It is like this, you should use the constant mix strategy. And because you keep on buying, it gives you a convex relationship, means it goes up like this, right? Convex. Because your portfolio value increase more than your stock value, right? Which is why M is more than one. Because you keep on buying more stocks as it increase. Okay, so is shown here like this. You keep on going up like that. All right. So comparison of various strategies. We have talked about the 3T strategy, buy and hold, where M is one, is good when um markets come neutral or going uptrend. The uptrend is quite good as well. Rising market, new trade outperform. Constant mix strategy is good when there's no trend, so it's just going up and down, up and down. The CPPI is a convex strategy. It's good when there is a trend up or trend down, right? It's not good when it's fluctuating. All right. So, any questions so far? Because this is the end of the rebalancing component of our discussion. All right. So I think we are good. Um, we will finish a bit earlier today. Now, the next lecture is the last lecture, and the last lecture, what I hope to achieve is we'll do the lecture notes, okay? But at the same time, we'll also cover the GBA, right? So I'll go through the GBA, depending on, because we have other classes as well, so depending on the marking of other instructors, I'll see whether we can release the mark paper. Um, if we cannot release it at the time of our lesson, you will receive it later, but we'll still go through the answers, right? So just rest assured you'll get back your paper on the last, at least we'll go through the GDA in the last lecture, right? Um, and and yeah, that's the next lecture, the last one. I hope you have enjoyed the lecture so far, that it has been interesting. Um, and you have any questions, I think I saw a post on your finals. So do check again. But if I'm not wrong, your finals is a closed book. So I encourage you to start preparing because there's quite a bit of materials that we have covered. So start preparing because it's a closed book. It might not be too easy. You can't refer. So please be prepared for it, your finals. Um, and yeah, I will stay on for a while for any questions, but those that need to leave, I know it's a Friday night as well. So thanks for coming. I hope and wish you a great weekend. Right. So if you have any questions, feel free to stay there because we are finishing at yeah. I'll pause the recording as well. Thank you.